My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job, not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Whenever I'm out and about, I connect with so many parents and children who watch this show together. And invariably, they want stocks that appeal to the kids. After a solid day where the Dow gained 115 points, S&P advanced 0.94%, and the NASDAQ jumped 1.51%. Buy. Once again, because of hopes for a budget deal and continued buying in artificial intelligence-related techs, I want to talk about picking stocks for your children. When I meet you in person, whether it be at TJX or Target on Wall Street or one of my wife's Mezcal bottle signs, the parents love to talk about the stocks we own for the charitable trust. Invariably, it's NVIDIA and Apple. They come up first. So do Amazon, Eli Lilly, even Caterpillar, Salesforce. They sate the parents. But the kids want more. They want their own set of companies, not their parents' fuddy-duddy ones. Stocks that are newer and admittedly more risky. I don't shy away from that because I know younger people have their whole lives ahead to make back any near-term losses. Normally, we don't spend a lot of time focusing on these higher-risk names here on Mad Money, but tonight, I'm breaking form. I'm going to give you the father, daughter, mother, son list you've craved for. The stocks that might turn out to be huge eventually, assuming they turn out to be anything at all. Almost all of them are young, what we used to call junior growth names. So they won't be the Netflixes or the Teslas or the Metas. The ones I'm talking about tonight are higher risk and potentially much, much higher reward, at least from these levels. So let's get right to it. We're going to start with a company we actually have on the show tonight, Celsius, which makes the most successful energy drink of this generation. Celsius just put up record sales for the first quarter, up 95% year over year. More important, just versus the previous quarter, their sales were up 46%. That's almost inconceivable. I think Celsius could be the next monster beverage, which is a huge success. And PepsiCo has taken an 8.5% stake in the company with an opportunity to buy more via a somewhat complicated formula. That's the kind of pedigree we're looking for here on Mad Money. Celsius could be the great non-tech growth company for the ages. Second, and in no particular order, is On Holding. That's the fastest growing sneaker company in the world. This Swiss company, backed by Roger Federer, just reported a 78% increase in revenue. Younger investors should worry far more about revenue growth than earnings per share. And this company crushed the consensus revenue estimates. It seems like every other person is wearing these darn things, right? On the On sneakers, you see them on people's feet. So no wonder it had a 92% growth in the Americas. Hard to beat. It only sold off when it reported this week because the stocks had a parabolic run. But after this pullback, I think you're getting a great chance to buy it. When? How about tomorrow? Third, Exponential Fitness is a terrific little company that uses a franchise strategy to offer the highest-end boutique gym operations like the insanely popular Club Pilates, a Cycle Bar, Rumble, Yoga 6, Stretch Lab, Pure Barre. Revenue growth, 40%, much better than expected. 20% same-store sales numbers, incredible. No losses from COVID, no stores closed. A multi-year growth path with excellent economics. I was really drawn to the story when we met them last week. If the economics of franchising intrigues you, as it does me, then you might want to buy some Wingstop. This company's a beat and race machine that always dangles a special dividend because they just make so much darn money. Lately, Wingstop's gone real upscale, driven by a universal thirst for chicken wings, fueled by their Uber Eats delivery contract, and a new chicken sandwich that's wowing the street. You might think you've seen these places everywhere, but in terms of expansion, I think they've barely scratched the surface. I love regional to national stories, and we have one that's temporarily lost its way, which means you might be getting a good buying opportunity. I'm talking about Dutch Bros. That's BROS. Yes, that's the super caffeinated Oregon coffee chain store that's putting down roots all over the country. Sometimes I worry that Dutch Bros is growing too fast, expanding too much. It just moved into Texas hard. It's making so much money. It's coming into the East. But you know what? It has not made the quarter. And that's caused them to take the eye off the ball. This is growth that is happening way too quickly. But you know what? I think they're course correct. I had my first Dutch Bros nearly a decade ago when my daughter was living in Ashland, Oregon. They called it the Annihilator. Downed it on Saturday morning, didn't sleep till Sunday night. My kind of elixir. Number 6, gambling's been a sucker's game all the way around, right? Except for DraftKings, which has come to dominate the online sportsbook industry practically overnight. DraftKings just put up some dynamite numbers, and we're not even in football season when they shine. CEO Jason Robbins runs a tight ship that's no longer hostage to approvals from state regulators. That hasn't how it trades anymore. I like the sportsbook, the casino gaming software business, but it's the daily fantasy bets that keep the juices going. DraftKings about to explode. Next, you know we love Estee Lauder for the investing club, but the other day at our club meeting, we admitted painfully that e.l.f., yes, e.l.f., the prosaic eyes, lips, and face, had bested our Lauder of late. Who would have thought that knockoff cosmetics made mainly in China would be so darn successful? The price is low, the outlet's great, the match is superb. e.l.f. is the comer in the category. What else? Now, we know work from home was supposed to be done already. Now, I am certainly sick of hearing about it. Then again, I wish I could come to the office on Saturday and Sunday. So maybe I'm an outlier, especially among the work-from-home gold brickers who survive on Logitech's equipment. People who work at home need high-quality Zoom wear. Logitech has that, too. Speaking of remote work, I think people really play video games at home when they're claimed to be working. No wonder Take-Two Interactive knocked it out of the park last night. Logitech also has all sorts of gaming equipment, along with other hybrid accoutrements that I sure hope I never have to find out about. For the record, I like to wear Brioni suits on weekends, even garden in them. I do listen to music with Logitech instead of earbuds, though. 9th, when I first heard of Five Below, I figured it was a super REI, a place where you could get all the goods you needed to climb Mount Everest. Nope, it mainly sells kids' toys with super hyper connections to whatever kids are watching right now. That velocity to market distinguishes Five Below from all the other toy stores, and its consistency is totally faddish business. It's awesome. Never seems to miss. Finally, forgive me, I have to do this. I have no choice. I have to include one senior growth stock in the mix, but I can't resist Lululemon Athletica, simply because I believe this isn't an apparel company at all. It's a lifestyle choice, and people are choosing it all over the world. Lulu used to miss numbers almost every other quarter, but now under CEO Calvin McDonald, the company generates good numbers so consistently that it deserves to trade at a higher level than its alleged peers. Yes, its market cap is equal to many of the other higher-risk, child-friendly names that I've got here on this wall together. But I will say this. There are few companies where parents and kids would shop together and maybe buy the stock together than this one. Bottom line, now you have your 10 companies for the future. No, not artificial intelligence darlings. I cover them all the time. Not graphics chips. Who brought you those first? Just plain old fast growers that are easily accessible to the younger generation. Enjoy. We'll have more over time. But if for me, I'd take whatever I had left from bussing tables when I was younger and put it to work in some of these horses. Bye. Let's take calls. Let's go to Brent in Michigan. Brent.
Jimmy, chill.
Brent,
the only thing better and more colorful than the maize and blue of Michigan football is the big house of greenbacks that you help us earn.
I like that. I like that. That's very spirited to start the show. What's happening?
For that, I thank you. I've got a question about one of our club stocks. You know, 2013 to 21, it shot up like a rocket. It's falling to earth right now. Another 5% last week. BlackRock just took it out of their medical devices EFT. Almost 100% insider selling with no buying. What is going on with Danaher? Is it time to punt it and hand the ball off to GE Healthcare?
Our viewers are so smart, and boy, do I like that GE Healthcare that Jeff Marks introduced yesterday at the club meeting. Okay, Dana, here's the story. Yes, the growth did slow. Why? Because their customers are biotech companies, and they've not been able to raise capital in the IPO market or in the secondary market. But I will tell you this. I think Dana has bottomed. We just bought some. I think the stock has come down. Here's the stock. These guys are an unbelievably well-run company, and it's down 90 points. Forget it. It's time to buy, not sell. I'm not capitulating. Danaher. Yannick in New York. Yannick.
Jimmy Chill, coming at you from Upper West in NYC. Thanks for taking my call.
Glad to have you on the show. What's going on?
All right. With all the uncertainty surrounding the commercial real estate market, I'm wondering how this proven leader will hold up. Buy, sell, or hold, Simon Property Group.
David Simon is a winner. He's unbelievable. He's done so many things to make his stores great. Everybody's quitting on him, but let's make it be known, David Simon, who, by the way, is not that nice a guy. I just put it out there that I think he's going to come through swimmingly. And boy, does he ever pay the distributions. Simon Property Group, that one is for me. There's a whole class of young investors out there looking for up-and-coming companies that they can put their money into. And while they might come up with some that have a lot of risk, I just gave you 10 stocks that I laid out that could fit the bill for someone aiming to get huge rewards out of their portfolio over the long term. No Mad Money tonight. Speaking of fast growers that are accessible to all, guess what I just said was number one? Celsius. And they've made it to the way to many fridges, including mine. So could the supercharged growth continue? I'm checking in with the CEO. Then we've been tracking the latest in the debt ceiling impasse, but while we wait for a deal, could opportunities still be had in this tape? I'm tracking which way the market could be headed by consulting the technicals. And negative sentiment's been dragging biotech lower. But tonight I'm eyeing one name up a whopping 500% in the past 6 months that you put on my radar screen and I think could still be worth buying. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.